The next long-term pattern is the reverse wedge chart pattern. These types of triangles have different names. Some traders may call it a megaphone chart pattern. Some traders may call it a reverse wedge triangle. The most important aspect to know about this chart pattern is that their apex is at the left-hand side of the pattern formation instead of at the right-hand side. Therefore, this reverse pattern can have its apex on the left-hand side pointing upward. Whenever they point upward, it can be tagged as a rising megaphone or a rising reverse wedge. Also, the apex may point downward. Whenever they point downward, it can be tagged as a falling megaphone or a falling reverse wedge. Also, the apex may be horizontally parallel to the midpoint of the chart pattern. Whenever it is horizontally parallel to the chart pattern, it can be tagged as a reverse symmetrical triangle or a centered megaphone. Both the rising, falling, and centered megaphone chart pattern has three price directional movement possibilities. Number 1, it can serve as a trend reversal. Number 2, it can serve for trend continuation. Number 3, it can also serve for a ranging medium price movement. This is one of the reasons why this chart pattern is classified as a complex chart pattern. This means that the pattern does not have a precise directional price forecast. As a beginner trader, it's best to apply this pattern to trade the continuation of trends in the market. I will show you how to approach any of these complex chart patterns and their directional price movements in the market. Here's the daily chart of the British pound sterling USD. Let's study how the reverse descending wedge chart pattern can be traded in the market. As we can see in this price chart, after the bullish rally got exhausted at the high here, the next high swing resulted in a double top. The bearish price here failed to confirm this double top pattern. And later, price went through a bearish wave count. After price made a double lower high here and here, we were able to construct a descending resistance trend line. At the second lower low here, we were able to construct another descending support trend line. Now observe the third lower high here. We can see how the upper trend line rejected price down. Traders who have an understanding of this pattern would have taken the advantage to short from this strong bearish candlestick here and place their stop loss above the upper resistance trend line here. Then place their take profit target at this support trend line here. We can see how the bearish movement proceeded down to test the lower descending support trend line. Traders who traded this sell setup would have profited from two risk-reward ratios. And at the third lower low test here, the support trend line rejected price upward. Intelligent traders could have bought this long candlestick here. Stop loss is okay at the support structure here. Such traders could have targeted the upper trend line of this pattern here. As we can see, there's another 2 risk-reward ratio profit target. At this upper trend line here, the best zone to short in this market is at the close of this bearish candlestick here. Traders could have targeted the lower trend line here. Unfortunately, price failed to test the lower trend line here. As a smart trader, if you were to trail your profit in this bearish move down, you could have trailed your profit to the high of this bearish engulfing candlestick pattern here before this bullish candlestick here invalidated this engulfing bar. You would have profited from almost 4.2 risk-to-reward ratios in this sell trade setup. This could be possible if you didn't get out of this sell trade-up when the market retested the upper trend line here. Again, this upper trend line of the falling megaphone proved itself to be valid. A smart trader should have bought this bullish candlestick here because the risk-to-reward ratio from the entry level here to the upper trend line here is not favorable. This is not favorable because the best level for stop loss is at the lower low swing here. As we can see, the risk-to-reward ratio is not up to 1 ratio. Price proceeded down to break the support trend line of the reversal descending wedge chart pattern here. In this type of bearish price breakout, it's better to wait for price to retest the broken descending trend line. Once tested, we need to see a bearish price action signaling the previous lower support is a new descending resistance trend line for price before we should anticipate the continuation of the bearish rally. Alternatively, price could break out of the upper reverse descending wedge chart pattern trend line here. If that should occur in a bullish trend, it's better to wait for a bearish retest of the broken upper resistance trend line. Next, look out for bullish price action to prove that it's new support for price before anticipating a bullish move. Remember, it's better to stick to the trend-following trading strategy of this chart pattern. Here's an example of why you need to stick to the trend-following strategy of this chart pattern. As we can see in this price chart, after price made a bearish breakout of the first falling megaphone chart pattern here, price movement resulted in a ranging market. Price later carved a reversal symmetrical chart pattern. The bears broke the support here. We can see how the bulls struggled to break above the broken descending support trend line here. The bulls later ensured a bullish close of price above this broken descending support trend line. Unfortunately, the next candlestick carved a bearish engulfing candlestick pattern. Buyers were trapped in this buy entry. As we can see, the bears stepped in to resume the previous bearish trend. Bullish trapped traders have no option but to exit their long position in this market. Once again, make sure you stick to the continuation trading strategy of this chart pattern. Once you become an experienced trader, you can then proceed to the reversal trading strategy of this chart pattern.